Before we begin, here's how to earn continuing professional education credit for attending this session. Gain valuable insights by attending the podcast, then complete the assessment test to download your certificate. To do this, follow these simple steps. Click on the link in your description to access the session. Create a free account and attend the podcast. After the podcast, take the assessment test and download your certificate. It's easy, and it's free. We highly recommend checking out our subscription. Let's get started.
The motivation for you to teach at Cornell was somewhere driven with that hustle that you had to go through, and then what was the thought behind it? Was it like a natural was it something like the university just approached you, or was it something like you're like, I want to do this because I don't want somebody else to go through this problem again?
Well, the solution to my challenge at that time wouldn't have been, me, a professor teaching or a lecturer teaching at a business school, mostly because I still wouldn't have had access to the business school I had not gone through the process that was already outlined for that. And so,
Yes.
so as a result, this didn't come from the place of let me help the guy like me. I do other things to try to help the guy like me. I do these sort of podcasts, and then oftentimes people will reach out to me and say, "Hey, I really want to, engage with you or connect with you." And I'm always willing to, share some advice. I'm starting to put together some programming to formalize this in a way so that I can be much more helpful to folks who are interested in buying companies. So if you're listening to this and you want to reach out, feel free to reach out. I have no problem connecting with you. But all that to say, the motivation for me when it came to teaching a class came really from three directions. The first direction was that, because I'm completing an undergraduate degree, I wanted to have the professional qualification of being like a lecturer at a major university. And I thought that would be a nice proxy for for not having completed a degree.
Welcome everyone to another episode of your favorite podcast, Accounting M&A Insider, where we explore what it takes to build, buy, and exit businesses in the world of private equity and acquisitions. I'm your host Saul, and today we are diving into what it really means to be on the buying side of the deal. My guest today is Bakari, an acquisition entrepreneur who's been buying and operating businesses across industries. He's also the founder of Graves Hall Capital and a lecturer at Cornell University's Johnson Graduate School of Management, where he teaches MBA students how to buy and grow businesses. Bakari, welcome to the show.
Thank you very much.
Absolutely. Let's start from the beginning. How did you first find your way into the world of acquisition entrepreneurship?
Yeah, let's see. So that's a interesting story. It starts in 2015, and I was around 25, and I was super broke, and I was asking myself, how do I get rich? That's really the core of the question.
Absolutely.
Trying to figure it out.
Get rich or die hard trying.
I was like, I'm broke right now. There's got to be some alternative to this. And so I basically just started reading as many books as I could about the subject of wealth building. I read Rich Dad, Poor Dad. I read I Will Teach You to Be Rich by Ramit Sethi. I read, like, you name the business book or the personal finance book. At that period of my time, I was just reading as much as I could, watching as many films or documentaries or just anything that could just give me some clear inspiration on how to do this. And
Right.
a lot of the personal finance stuff that I had come across at that point was mostly about like how to save money, how to invest your earnings so that when you're in your 50s or 60s or 70s, you have a healthy retirement, and you'll be able to live off of $5,000 or $6,000 a month without having to work. And I was like, yeah, but that's not what I'm referring to as rich. Right? Like
I need to get rich.
I'm trying to figure out how to, like, I don't think Mark Zuckerberg was investing in the 401k and then that was his approach to wealth building. Like, it seemed to
Yeah.
me it was something more active that I should be doing. Uh,
Yeah.
and and so I came across, real estate people who are selling real estate courses, sort of similar to like what Trump University used to be about, where, you go sit in a seminar and they'll teach you over, the course of like 3 weeks how to buy a property and flip it, or buy a property and, rent it out to tenants. And I was like, yeah, but it still didn't feel as active as I could. Of course, real estate's successful, but it also seemed like there was a very high barrier for financially to do it. Meaning you had to
Yeah.
be able to afford a lot of the surveyors and the examiners and the engineers and the cost of the debt and all this. And I was doing this with
Absolutely.
less than $2,000, saved in my account. And I was like, how do I, what is it that I can do right now? And I came across this phrase, these three letters that I would see repeated in lots of different books, a lot of different subjects or a lot of different like contexts where they would just mention this acronym, and I didn't know what it was. And one day I typed it into YouTube, LBO, actually I typed it into Google, which sent me to YouTube. And that's really the beginning. I learned what a leveraged buyout was,
Wow.
where instead
Yes.
of using debt financing to buy a property, you could use the same method to buy a business. And
Right.
uh, and you could pull capital from so many different sources for that purpose, to acquire the business. And where the concern of both investors, lenders, other key partners who could help you get this done, their concern wouldn't be as much on what your personal background was, what your personal story was associated with this deal, as much as it was focused on what has the business done over whatever period of time it's existed, and using that as a proxy for determining whether or not it would be successful in the future. And so
Yep.
when I learned about this, I was like, oh, this is fantastic. And so my next question was, uh, now how do I do this? Right? Like this seemed like the way to the thing. Like I learned, I found out, a strategy that could build wealth, but what do you do? And there was no real written information about how to do this. In fact, at that time, really the closest you could get to actually doing acquisitions, in a sort of formalized way, was to go to undergrad, study finance, go join an investment bank for a couple of years, then go to a business school, and then eventually you can go work as a private equity associate at a major private equity firm. And still you'd be doing deals on behalf of your LPs, but you wouldn't be doing deals on your own.
Yeah.
And the goal was not to become the world's greatest private equity professional. It was to get rich. Like I just want to
Yes.
buy a company. And so I was looking for, how do I do this where I can sidestep this? And I came across this article that was written in the Harvard Business Review, which is
Right.
called Early Career LBOs, where I learned that at the business schools, they were teaching, you know, people just my age, 20 at that point, 25, 26, 27, how to buy a company, own it. Not only could they teach you how to buy the company, but they'd also teach you how to source the business. They would introduce you to capital sources. They would personally invest, meaning the professors who are in the program would teach you this. Like this was all happening at Harvard Business School, getting people prepared to not join Bain, not join KKR, but instead to buy their own company. And so I learned
Nice.
that there was being taught at Harvard Business School and at Stanford Business School. Now, I hadn't been preparing for getting an MBA, so from my perspective, I had no access to this information. But I happened to live in New York City, and just at that point, there was, or just as I was learning about this, they had just opened a new course, this exact same course that they were teaching, that had come out of this white paper that was written in the Harvard Business Review. They had just started teaching that same class at Columbia's Business School, and the
Nice.
opening for that course was going to happen or at least the first date of the new course was going to happen maybe 2 weeks before I came across that article. And
Nice.
so 2 weeks after I came across that article. And so I put some time in my calendar to make sure to go to Columbia Business School, sneak in the back of the class and sit, learn how to buy a company from a professor. And so that's
Yeah.
basically how this whole thing started. I was trying to figure out how to get rich, and I just did a lot of research, and eventually ended up in the back of this MBA class at Columbia's Business School.
Do you want to earn CPE credit? Take this course of MyCPE ONE to earn free credit. Click the link in the description to get started.
Yeah, I think you touch on very interesting points because one, all the literature out there is driven on an assumption that you have capital
Right.
and you wanna, grow,
Mhm.
or also for the fact that when you're also getting into this acquisition side of it, it's assumed that you have capital and now you're looking to acquire because you have this money and you want to put it to use, so you'll probably buy a company or something.
Right.
And like you rightly pointed out, it's always fascinating whenever I talk to people. It's always fascinating when I come across people like you who stumble into acquisitions in this and who know about the leverage buyout. A lot of people have, like you said, they probably have just like heard the word, or maybe they've never even heard about it. Like they may even have an idea that what if I could have a lender like a bank give me the money to buy the business? Is it possible? They may have been thinking about it, but they didn't know that yes, it actually exists. There is a process. It's called a leverage buyout. That's the term used. And that's the acronym because M&A, the industry, is full of acronyms. There's so many. I mean, M&A itself is an acronym. It's like
Mhm.
nobody says mergers and acquisitions every time. It's always M&A, M&A. So it's always fascinating how this comes across, and then you stumble upon things, and now you know it. You do the right things. You actually got guided in the right way. I guess it was also very timely because you're reading something, and then 2 weeks later you see, oh, this is exactly the course that I was looking for. It's just one of those situations where you are, if you're not down and out and you're looking at all the opportunities out there and you're able to grab that right opportunity, will lead to it can lead you to beautiful results. And that's exactly what it's been. It's really fascinating. So thank you for sharing that role, that's journey of yours. It's very motivating. and
Thank you.
and then you you started off with this process, and this leverage buyout was one part of it wherein you could finance about it. But for financing it, you yourself would have to evaluate a business to see worthy enough that a bank would also consider, or an external lender would also consider giving you the money for, right? So how did you get to know about that? What are the things to look for? How do you evaluate that business, and what are the top things that you really look for when you're looking into acquiring a business?
Yeah. Uh, I'm gonna jump ahead in my story just to give people as well like a sense for how this actually ended up playing out. So from finishing from sitting in the course, where I sit today is I completed two acquisitions. First, I bought a burlap bag manufacturing company in partnership with a private equity firm. I did that deal about 2 years ago. That was like around 30 million top line revenue, close to 5 million in total EBITDA at close. Before
Wow.
that, I completed an acquisition of an educational technology company in partnership with the family office. It was around a
Hmm.
$20 million top line revenue, about $3.5 million in EBITDA. And
Nice.
right now, I'm in the middle of acquiring another business that looks like it should close within the next 2 months, which is around 35 million in revenue, about $5 million in EBITDA. And so I basically I've figured out how to complete acquisitions. And then separate from that, I actually ended up working in private equity firms. I've worked as head of mergers and acquisitions for an artificial intelligence company, head of corporate development for an engineering software business. And then, as you mentioned, I also teach this subject. So the class that I snuck into at Columbia Business School, I also teach that class now as a part of a larger course inside of Cornell's business school, pretty much every fall. And so yeah, so basically from that class, that's how all this started. So the question you asked me earlier was, or the question that started this conversation was, how did you learn how to evaluate a business? Meaning, consider
Yes.
you didn't come from this world, you just sort of sat in the back of the class, and that was what it was. It was for me, it was starting from I gotta learn. right? And so I mentioned in the beginning of this conversation that I read a bunch of books around personal finance. I was by the point I got into the class, I was not I was the phrase a P&L was not a surprising phrase to me. I knew what a balance sheet looked like. I knew how to evaluate, a personal financial situation, but I had not yet done the work of being able to evaluate businesses. And so that's what finding a university course was about. It was not just, I didn't want to just be motivated, excited. I want to buy a company and then try to put this on and crash out and then wonder why didn't someone warn me of all the, the pitfalls of this thing? Because it's not as simple as buy a business and be rich. There's also a bunch of work that has to happen both before you buy the business and then once you own the company. So it's
Yes.
not as simple, but however, it does provide, the strategy does provide a sort of a leapfrog opportunity where you can step from being, poor to being, upper class pretty quickly. And so all that to say, the focus was in that class, learning from the professor. Over time, I started to develop a relationship personally with the professor, and I would bring him my situations so I not only was I going out and sitting in the class, but it was a practical class. So you had to go out and look for a company to buy. You had to do the work of hunting for businesses, and
Nice.
that was the way it was. It was sort of a challenge between both the students and the professors to make sure that you're learning, and then developing a personal tribe of people who were also doing the same work, who I could sort of sharpen iron against iron, evaluate businesses, and then actually go out in the field and evaluate them on my own, right?
Yeah.
And see, put theory that we're in the class against practice out in the field. And so that was those are the key components that I took to develop the strategy.
So, you mentioned about, this is something that's very, synonymous with everybody that I speak to. Whenever I talk about, what is it that you look for in a company, or if somebody's even looking to acquire the company, the very first question they ask is, what's the revenue, what's the business that they're into, and what's their EBITDA? That's
Mhm.
like a de facto thing. Like, they have to know these figures firsthand to at least even consider looking into it. That is it something that I really need to look into, right?
Mhm.
Why is EBITDA so much of a key factor?
Well, I mean, ultimately that's what I'm going to use to pay the debt. As I mentioned, this all started from the phrase of a leverage buyout, right? Like the thing that we're
Yes.
doing, engage in the work of leverage buyouts. And so a leverage buyout, the key part of that acronym is the L, right? The leverage.
Yeah.
And
Yes.
the way you pay for leverage, and the reason why you can execute a transaction at least at the size that I've done, or higher, even when you don't have capital, is that you're using the profits of the business to pay off the loan and also to pay NA investors who are a part of the purchase. And so that's really the whole core of the thing. If the business doesn't have any EBITDA, then it doesn't really make a lot of, it's not very easy for you to value that business using the methodology that we're applying as leverage buyout professionals. And so that's why EBITDA matters. But there are some people who will abstract even farther away and say, hey, EBITDA is earnings before interest, taxes, depreciation, and amortization. That's good, but it's not true cash flow. And so some people will rip
Yes.
even that acronym, try to get down to the actual cash that's generated by the business, it's set aside after all expenses, and then using that number instead as a form of valuation. But end of the day, that's what we're looking for. We're trying to understand how much can this business actually support, or on the leverage side, for the acquisition.
In fact, there's a very interesting conversation that I had. I did a webinar, because I do these monthly webinars on talking about the M&A transactions and the private equity inclusions in the accounting industry. And there was this interesting conversation that we had in which we were talking about EBITDA, and then we were talking about the adjusted EBITDA. And then he was talking about, like, if there is an owner exiting out, right? But the owner is investing a significant portion of his hours into the business. So that, and plus how much is he taking away from the business as salary or whatever that may be. So if this owner is not going to be there, you're not just looking at, all right, he's probably taking 20% of the EBITDA. 20% of the EBITDA compromises the owner's salary, which is very high. You don't
Mhm.
usually see that, but assuming if that's the case. So it's okay, if the owner is not going to be there after the acquisition, that would mean that I'm going to be getting all that 20%. But what you need to also equate into the consideration that for that salary that is withdrawing and the hours that is putting into the business, if I'm going to be not having him there, the people who are going to be doing that work, how much is it going to be costing me to have them on the business?
Right.
And that's something that, these are some very small things. You're talking about EBITDA and cash flow, and these are some very small nitpicky things that usually people tend to miss out when they're initially evaluating it. Naturally, the due diligence process obviously opens up its gateways to a lot many things. Looking into various valuation models, whether it's an asset based or a discounted cash flow model or whatever model you're going to be using. But these are some very nitpicky things. You got to look into the DNA of a business. You can't just look at it as surface level numbers. You got to go into the DNA of the business. And you when you started, were you looking to stay like a generalist, or did you want to like eventually see yourself specializing into buying certain kind of businesses?
Access latest and trending CPE courses with my CPE One Unlimited Access subscription. Subscribe now.
So because of my background, I didn't have like a already established, specialized, what's the word, industry background. I was a salesperson before I was in the private equity industry. And
Right.
so I had worked, selling digital software, selling other types of solutions. And so, and in my professional life, and by professional life, I mean, I graduated or finished school at 21. And then I started doing this when I was 25. And so that's 4 years of professional work outside of the scope of of professional life. So
Yeah.
it's always fun when people ask me, so what did you do before you did private equity? Frankly, I'm not really certain I have like a real strong professional affiliation before that. And so as a result, when I came into the private equity world, I really just had a general view. Like I said, hey, I want to buy whatever I can buy. So I didn't expect to buy an educational technology business. That wasn't like my approach. I didn't expect to buy a burlap bag manufacturing company. And the industry that I'm pursuing right now, this is not an industry that I had stepped into the world and said, this is the type of business I want to buy. And so it's mostly been, very, what's the word? Uh, Opportunistic and
Yes, that's the word. That's exactly the word I was going to say. It's an opportunistic thing, right?
so what opportunity comes and I take fully advantage of it, evaluate, and that's how we end up moving forward.
I mean, I want to ask you this question because, this comes from, I think I saw a movie in which, which one was that? Pretty Woman. All right.
Yes.
Right. So, he used to do, he was like an aggressive acquisitionist, right? And he had a team and they would do the hard work for him. And okay, this is a good prime target. We can acquire it. Either it will be a hostile takeover or whatever it may be. So do you like you're also the owner of Graves Hall Capital, right? So uh, two questions. One is, what led you to start that? And second was that, do you have like a team that kind of like goes and starts hunting your targets and then gets you those good deals?
Funny, I watched Pretty Woman again for the how manyth time, like 2 days ago. So I I often tell people that it's funny that one of the world's greatest like chick flicks, like romantic
Yeah.
comedy, world's greatest romantic comedies, is also a pretty good business movie. Like it's
Yeah.
like the
Yeah.
guy,
It is.
he conducts a legit private equity transaction, and does most of like the key items that I do in my professional life, including dinners, including evaluating the properties, including meeting and negotiating with the owner. Like it was kind of funny. I can enjoy that movie sitting right next to someone who has no interest in the business portion of that. Like in fact, I've asked people who have watched that movie before, hey, do you remember what Richard Gere's character does for work? And they say, oh, I just know he's like, I don't think he's a lawyer. I think he does something. Like they never know what he does.
Yeah,
And so they can
yeah.
enjoy that movie, and I can sit right next to them and enjoy the movie for a totally different reason. But yeah, so Graves Hall was the firm I founded right after leaving the business class that I was sitting in at Columbia Business School. Effectively, you need to create a legal entity to
Yes.
shield yourself from different concerns that can pop up as you're navigating this acquisitions work. It's not always, it's not, all I have to say, you just need to have a legal entity that's protecting you from different liabilities. And so I created Graves Hall Capital. And Graves Hall, I misspoke earlier. I said I graduated when I was 21. Graves Hall, I actually dropped out of my undergraduate school when I was 21. So I was there for all 4 years, but I didn't complete the degree. But Graves Hall was my freshman year dorm at Morehouse College, which is where I attended school. And and so I named it after Graves Hall, really saying like, look what I've accomplished with only, with just the freshman year, right? Like that was the sort of the conceit behind Graves Hall. It
Yeah.
was to say, I didn't do much. I didn't do more than great. I didn't get past Graves Hall, and yet, here's where things are. And at that time, when I found the Graves Hall, nothing had really happened. I had just decided that I wanted to buy a company, and then started the work of trying to get it done. And so it was also somewhat aspirational, the name. Since then, as I mentioned, Graves Hall has completed a few acquisitions, and it's on its way to completing the third deal. And really, most of the key parts of the company are held within me, and then I outsource specific key tasks to members in my network who can execute certain things. But I've never hired a full-time employee to Graves Hall.
Interesting. Interesting. Well, naturally, like that's very understandable. Somebody who runs with numbers and who is able to look into the costs and profitability and everything, I guess it's a very planned move, and that's a very planned mechanism. You wanna be able to effectively get everything done when you want it done, because the nature of the business is such, right? It's not like you're doing deals every day. I mean, that would be a different world altogether. But that's not how it happens, right? It's an interesting process, but it's got a life of its own. It's got a speed of its own. Each deal has got its own unique features and things to talk about and challenges, and so when the time comes and when you need it, you need that person, and offshoring is the best way, because that way, when you need it, when it's the need of the hour, you're able to execute it, get those things, and then able to get it going. Very interesting. Very, very interesting. But good to know. Good to know. It's a very interesting setup. A lot of people don't really think about it that way. They usually think that, oh, if you're going to be doing it, we need to have employees who are going to crunch the numbers, do the due diligence, and do all those things. But this is a very, very interesting initiative that you've done. So thank you for sharing that. So with you know I'm certain that the motivation for you to teach at Cornell was somewhere driven with that hustle that you had to go through, and then that, and you I mean, what was the thought behind it? Was it like a natural was it something like the university just approached you, or was it something like you're like, I want to do this because I don't want somebody else to go through this problem again?
Well, the solution to my challenge at that time wouldn't have been, me, a professor teaching or a lecturer teaching at a business school, mostly because I still wouldn't have had access to the business school have I had not gone through the process that was already outlined for that. And so,
Yes.
as a result, this didn't come from the place of let me help the guy like me. I do other things to try to help the guy like me I do these sort of podcasts, and then oftentimes people will reach out to me and say, hey, I really want to, engage with you or connect with you. And I'm always willing to, share some advice. I'm starting to put together some programming to formalize this in a way that so that I can be much more helpful to folks who are interested in buying companies. So if you're listening to this and you want to reach out, feel free to reach out. I have no problem connecting with you. But all that to say, the motivation for me when it came to teaching a class came really from three directions. The first direction was that, because I'm completing an undergraduate degree, I wanted to have the professional qualification of being like a lecturer at a major university. And I thought that would be a nice proxy for for not having completed a degree, and particularly if I could, be able to teach in the subject that I'm most well known for and have the most experience in doing. And so the professor who taught the class at Columbia Business School would often invite me back to the class to teach to his students about sort of gusto and moving forward and what it takes to navigate this when you don't have the background and this and the third. And it was like
Yeah.
a really kind of experience because I was surrounded by people who all wanted to buy a company. I was in the midst of the work of trying to get an acquisition completed, and at my experiences, which when I was outside of that room would almost be like laughable. When I was talking to people who hadn't even considered buying a company, they would hear me, this broke kid trying to buy a company that's going to cost millions of dollars, and they'd be like, it almost sounded foolish in their mind. And then I was in that room, and when I would teach, to the students, having not yet done it,
Yeah.
it was lauded. And so once I completed multiple acquisitions, then I wanted to do it and not just teach this is what the hustle is, but also formalize it into a practical seminar. And so
Absolutely.
that's what I formalized with through the class I teach in a larger course at Cornell's Business School, a strong seminar teaching the students there how to buy companies. And then I've been so since 2023, I've been living outside of the United States, and so I live in a different country every month. And so I've started doing adding this sort of global lecture tour to this. So just last month I was in Cairo, Egypt, and I taught the same seminar that I do at the Columbia Business School, actually at Cornell's Business School, at like 3 or 4 co-working locations in Cairo.
Nice.
And I'll continue doing that as I sort of leave from this country to go through Europe and some of the other nations that I have upcoming as well.
Wow. Wow. Sounds like a fairy tale, but you're living it. So wow. I mean, like, just phenomenal. And let's flip the table a little bit, right? You are at the buying side. But when you're at the buying side, in fact, this is something like a misconception. People think that, there are a lot of buyers out there and you go there to sell a company, there are buyers waiting for you. No, that's not how it is, right? It's never like that. And neither is it like, there's so many people to sell. You want to buy a company, you just go there. There are a lot of sellers waiting. You can just choose one. No, it's never. It's not. It's very tumultuous. But anyway, if I were to flip the perspective, there must be times when you're engaging in the conversations, what do you see most sellers missing the mark when they're pitching their business to buyers like you? I'm sure you have that conversation. Tell me about your business, and then they're like, you know, they're missing the mark somewhere.
Yeah, so I would say this. So there's a conversation that I often have with owners of companies when they're interested in selling the business or engaging a conversation and selling the company. And it's usually this, which is when I commit to an owner and tell them that I want to buy their company, I'm willing to put all of my effort into getting that transaction done. And so I'll be clear that this deal can close within 90 days of us agreeing to sell the company. Because I know all of the parties that need to get involved. I know how to get these transactions completed. I know how to source the capital. I know how to get that whole entire process moving off and completed. I've done it multiple times.
Yes.
The challenge oftentimes is that despite a seller who is interested and willing to sell their company, they have not yet put their house in order to be able to
Oh,
sell.
yes.
And so
Yes.
their concern when I step in the door is that this is going to take a long time because I'm going to slow the process down. but almost every time, in fact, every time, and I look, there's not been a single time that this has not been true, is that the holdup comes from the seller side. There'll be
Right.
requested from the seller, and the seller takes weeks to fulfill that request, which slows down the process. They don't have the correct advisors around their table, so they have to go and find an accountant. They have to go find an attorney to handle certain parts of their business, and not an attorney who handles real estate and wants to do this M&A transaction, but an M&A attorney who does M&A
Yes.
transactions. Right? Like, these are the types of people who, need to be surrounded with the seller. Separate from that, they got to get their team prepared, not necessarily by letting them know that there's a sale happening, but get them prepared for exporting massive amounts of information out to the owner, so that it can get in my hands without also exposing to, potentially employees who might get skittish and want to, exit the transaction. So there's all these things, and these things tend to come as impediments from the seller side, very rarely coming from my side. It's never
Yeah.
been I'm the holdup on this transaction. It's almost always on the seller side. And so the main advice that I give to anybody who's interested in selling is make sure, do as much as possible. You can't do everything, obviously, because you're running a company. You're not in the business of selling businesses. You're in the business of running your business, and now you have somebody who's interested in buying it. But do as much as you can to prepare your house, with the correct financial statements, the correct advisors who are on standby, ready to engage. All of these people, all these points of context, use ChatGPT and ask it, hey, what do I need to do to prepare myself for sale? Reach out to advisors and let them know. Reach out, and my preference is always to, engage directly with an owner without having, a specialized advisor involved, meaning a business broker or an investment banker. I always prefer to have that one-to-one connection. But some owners, they do actually need to have an investment banker or a business broker or their accountant to come and step inside and take on the role of being intermediary between me and the owner. And if that's the case, engage with them early and let them know, I'm interested in selling my company. Not just how do I maximize the sale price, but how do I maximize the likelihood that this is going to close, and that the holdup for the close doesn't come from my side of it. Always, if there's going to be a holdup, it comes from the buyer side. And so that would be the key advice I want to give out to anybody who's interested in selling a company.
Well, Bakari, I gotta tell you, what you're telling me is music to my ears, because before you, I had a podcast done with this gentleman called John Varilo. He's written a book called Built to Sell. All
Yeah, I
right.
was on his podcast a couple, maybe like a year ago.
Oh, is it? All right. I don't know. He said the exact thing. I mean, that's what he's talking about. You got to get your house in order. And what do you need to do to get your house in order? He's letting you know that this is what you need to do, and that's exactly what it is. If you are nobody thinks about exit when they're running a business. Like you rightly said, you're not in the business of selling your business, you're in the business of running your business. So that's what's there. But when you think about it, maybe you're reaching to that point, maybe in the next 10 years, you got to start early. You got to start building your practice to that point, that when that point comes, you're ready with it, instead of running around getting all that data and everything in order, and all those, everything's in processes and everything in place. So very, very rightly said. I couldn't agree more to what you said. And when you decide that a deal is good, and you're going to be moving forward, when somebody's serious about a deal, the seller has got everything ready, and then there is this thing about there's an element of what we call due diligence. It's a process that goes through, right? Once you're serious. So what kind of diligence processes do you run before making a final decision? Do you also kind of do like a cultural fit analysis during the due diligence and all that?
Those are good questions. I've never done a culture fit, but mostly because, well, I guess that's not necessarily fair. Whenever I've worked as as a employee for another company doing deals on behalf of them. So, for instance, when I was director of corporate development for the engineering software business, or or when I was head of M&A for the artificial intelligence company, when I was in those roles, culture fit mattered more because those companies were going to be integrated into the new business
Yes.
or into
Yeah.
our business. Right. And so that integration process is very critical, and can blow up, perfectly great.
Yeah.
And so that's really the key effort within the mergers world. Where I work, the work that I do as a professional outside of corporate employment is as an independent sponsor. And in those worlds, the only thing that's truly changing from the acquisition is usually a change of top line management, but not usually the actual culture of the entire business and a shifting away. In fact, the goal ultimately for those businesses is for them to stay constant. We don't want to change their cultures. We don't want to change the way that they do business, because ultimately the reason why we're buying the business is because we think there's a great platform, they're a great foundation. And so the only thing we want to do is amplify their efforts, and so that they can continue doing exactly what they're doing, just on a higher level. And so that, I would say, that's the key difference between the sort of the M&A work. And so when it comes to diligence, a lot of my effort is around evaluating the revenue of the company and making sure that it's likely to sustain itself going into the future. There are certain key issues that I'm trying to evaluate pretty early, things like key man risk and customer concentration, and other elements like that have big impacts on both valuation, but most importantly, the safety that I feel in the profitability of the business sustaining itself going forward. And so those are really the key core items I'm looking for.
Very interesting, very interesting. And now that you mentioned this, I've got this very curious question, because this is a question that somebody had asked in a different webinar, but that was unrelated. But I think I can ask you this, because when you're not going to be changing anything about the business, you're just changing the top line, right? But the top line eventually changes, and you may not be like heavily invested into the business, because you will eventually have somebody who is going to be running the business and everything. But how do you balance, the leadership development? How do you approach that leadership development inside the companies that you acquire?
I mean, it's different every time. It's the key critical challenge. I've owned companies where we've had to shift out management 3 times in 2 years. So it's obviously like a major concern, that as I mentioned, it shifts every single time. And so there's no lasting answer to that question, as much as it's like, stay on it. Don't let this type of thing, just fester and soar. When there's a major challenges, address them early. Try to develop your talent, keep a running pool of potential resumes active, have, recruiters out in the world who are trying to identify, A and B players who can potentially join your organization. And yeah, that's what I would say.
Okay, curious question. There's acquisitions wherein you're going to be acquiring, you're changing the top line. Now you're the new boss, what's not, everything. And then there's this other thing about, businesses who are not really looking to exit per se, but they just want to take some chips off the table. They're looking for some growth capital or something like that, right? So if have you been in a similar scenario wherein you're like just infusing some growth capital into the business?
Yeah. So the first deal I did, though, I was buying that company to change out the ownership, and become the leader of that business. So I was going to take on the CEO role. When I brought in my investors to that transaction, the seller recognized that there were still some things he could accomplish, and he loved the investment group that I brought together. And so altogether, we decided to keep him on as and remain CEO. And so that's basically how that transaction played out. So it was exactly what you just described. My most recent transaction, we actually, the sellers were looking to exit the business from the management standpoint. And
Right.
so we bought the company and brought in a brand new CEO to run that company full time.
Nice, nice. So, there's this thing that people ask me, because they want to know what the structure is. Because sometimes, like you said, you're getting acquired into the company. That's one thing, because there's a kind of like, you see that roll up opportunity, you're able to upgrade their tech stack and, get them better access to resources and everything. So that's happening. And then there is a deal structure in which you're actually creating a separate entity, and that entity holds all your companies and all your investments on your portfolios and everything. So what
Mhm.
kind of structure does Graves Hall Capital employ when acquiring companies?
So Graves Hall is the umbrella organization that owns shares in all the businesses that we
Nice,
buy. And so
nice.
So people would refer to that as a holding company. I don't really
Yes.
step into I don't really step too much into those sort of definitions. I just think of, my firm as a private equity firm, and we buy businesses.
All right. Now, we are almost approaching towards the end, but before I let you go, you already mentioned, in fact, this is the question that I have towards the end, wherein I ask people that what are the books that you'd recommend, but you already told me.
No,
you
I mean,
read so many books. So.
that's a good question. I would still answer it. So the first couple books I mentioned, Rich Dad Poor Dad, and I Will Teach You to Be Rich. Those are much more personal finance books. Those are good books to read if you want to, better handle your personal life, but really wouldn't have much guidance on this world, the acquisitions world, the private equity world, buying companies. What I would recommend is John Warrellow's book, Built to Sell. I think that's one of my favorite books. It was the first book that really it explained to me what the other side was like, the people who are trying to buy the companies. There's a great narrative book that I like a lot called Cash McCall. They made a movie of it in the 1960s, but it's about an individual who goes out buying companies.
Nice.
Probably one of the earliest books about this subject ever written. And as I said, it's a novel, so it's a really fun book. So Cash McCall, and I think those are probably the two.
Very interesting. Very interesting. I'll definitely check that one out. Cash McCall, I'll definitely check that out. So, Bakari, this has been incredible. I really want to thank you for your time. So, where next? You're currently in Egypt. Where right now?
So right now I'm actually in Tel Aviv,
Ah,
just outside of Jerusalem. And then from Tel Aviv I go to Berlin, and then London, Paris, and Rome. And I'll be doing the lecture series in each of those locations.
beautiful, beautiful. I look forward to it. So, how can people come to know? How can people get in touch with you? What is the best way to get in touch with you?
Best way, LinkedIn, reach out to me via LinkedIn, connect with me. I'm always willing to chat with folks. My email is in the description box. So if you want to just go directly to my email, you can do that. So yeah, those are probably the key places: email, and LinkedIn.
Well, this is great, Bakari. Thank you for such an incredible deep dive into how thoughtful buyers approach deal and how firm owners can think more strategically about the business. This has been really phenomenal. It's been like a masterclass in itself. So thank you so much for sharing this. And to everyone listening in, this is what Accounting M&A Insider is all about, right? Real conversations with people actually making deals happen. So if you got value from today's episode, be sure to follow, leave us a rating, share it with a founder, advisor, or a future acquisition entrepreneur. Who knows, right? So until next time, keep building, keep preparing, and as always, keep innovating in everything that you do. Cheers.
Access latest and trending CPE courses with my CPE One Unlimited Access subscription. Subscribe now.